Hey there and welcome back to the third episode of The Art of Trading with Ichimoku. The Ichimoku trading system, when used correctly, can meet a significant portion of your trading needs. But when combined with other proven methods like price action, you can get even better results. Let me give you an example to make it clearer. If you have some knowledge about classic price action, you are probably familiar with the QM pattern. If I were to explain it very simply, the QM pattern bears some resemblance to the head and shoulders pattern in many ways. However, the key difference that sets it apart from that pattern is the downward sloping neckline. This is the line that connects the pattern's swing lows. In the QM pattern, the reliable entry point is usually when the price breaks below the pattern's lowest point, which confirms the initiation of a valid downtrend. However, in many cases, this pattern fails, and the price continues its previous trend after breaking above the pattern's highest point. When we combine the Ichimoku system with any price action pattern, we can have a better prediction about its performance. Here, we can see that the Tenkan-Sen has transitioned from resistance to support, while the Kijun-Sen has flattened out. Therefore, an upward movement is likely to happen, which might form the right shoulder of the QM pattern. When the price follows our expectations and starts this upward move, it precisely reaches the upper boundary of the cloud, at which point it seems to lose momentum. The shape of the resistance that Kumo provided for the price is also interesting here. We extensively discussed this type of support and resistance the cloud creates for the price in the previous video. Furthermore, we can observe that the future cloud has turned red, which is the first sign of a trend reversal. However, we still don't have valid confirmation signals to enter a short trade. This is because the price is still trapped within the thick green cloud. As we move forward, this powerful cloud gets broken with a big bearish candle, and both the Tenkan and Kijun move below the cloud, similar to the price action. However, the Chiku span has not broken free from the cloud yet. Therefore, we are patiently awaiting this event. Continuing further, it seems that all the conditions are in place to short this pair. We have double confirmation from both the QM pattern and the Ichimoku system. Moving on, as we can see, a powerful downtrend begins, and both the Tenkan and Kijun confirm it. However, as you know, the exit point is just as important as the entry point. Therefore, we need to find suitable exit levels for our trades with the help of Ichimoku components and past market data. If we carefully examine the historical price movements, we can notice that at the level I have marked with a red-colored line, the Kijun and Kumo have aligned perfectly and are maintaining a flat position. In the previous video, I discussed this Ichimoku scenario in detail, and you are aware that these levels can be used as valid entry and exit triggers in the market. Therefore, we will use this level to exit our trade. When the price reached this level, it developed a reverse candlestick formation called an engulfing pattern, which terminated the downtrend. Therefore, here we can see how the combination of classic patterns with Ichimoku can provide safer trading opportunities. Another Ichimoku strategy, which mainly relies on the Tenkan and Kijun lines, is when at the end of a strong uptrend or downtrend, these two lines suddenly form a similar shape with a specific time gap. In an ideal scenario, this time gap would be 17 candles. This is calculated based on the difference between the Kijun and Tenkan periods, which are 26 and 9, respectively. Here you can see that the currency pair has been in a long-term uptrend and above the cloud for an extended period. While it may have looked like the price broke the Kumo during the middle of the trend, it was not a valid breakout. As we continue with this series of discussions, you will learn the characteristics of a valid breakout in the Ichimoku trading system. Additionally, it's evident the price has stayed away from the Kumo for quite some time now, so at any moment, it may try to narrow this distance. This would result in a decrease in the market's bullish momentum. Finally, when the Kijun enters a flat state for a prolonged period and the Tenkan also shifts its role from support to resistance, the first signs of weakness in momentum are identified, resulting in a neutral trend. However, after a relatively short period of time, we observe that the Tenkan and Kijun lines resemble each other to a remarkable extent. What's interesting is that when we measure the distance between their corresponding highest points, we find that they are 17 candles apart. Although I have occasionally seen similar patterns in financial markets where the distance between them is less or more than 17 candles, and the pattern has somewhat worked accurately, this is my ideal distance. However, when we see signs indicating the possibility of a downtrend forming in the market, we need to be patient and continuously monitor price behavior until you get the final signal to enter a trade. The entry signal is triggered when the price firmly establishes itself beneath the bearish Kumo, and almost all components of Ichimoku indicate a market decline. Therefore, entering the market after observing this bearish candle and placing a stop loss above the Kumo can be an appealing trading idea. As I mentioned before, when the Kumo and Kijun align with each other in a flat manner or when the components of Ichimoku form consecutive peaks, they provide highly suitable areas for exiting trades. I have depicted these areas as yellow bands on the chart. Continuing further, it can be observed that the price, after a sustained decline, reached both profit targets before bottoming out. There's another strategy I'd like to share with you that closely resembles the previous one. It involves observing the Tenkan and Kijun lines as they form a hook-like shape at the same time. Following this formation, both lines move in parallel, maintaining the same direction. This pattern is a sign that the two crucial components of Ichimoku, the Tenkan and Kijun lines, are in complete agreement with each other to initiate a medium-term or long-term trend. In this chart, the Tenkan and Kijun lines form a hook-like pattern simultaneously, moving in tandem and pushing the price downward. By paying attention to the other components of Ichimoku, we can notice that the Chikou span has broken the price and the Kumo and stayed in the safe zone. Additionally, a bearish candle has formed below the current Kumo, but the Tenkan and Kijun lines are still above the current cloud, and the future cloud is still green. In this case, due to the formation of this powerful pattern, the confirmation provided by the other components of Ichimoku is sufficient for us, so we can consider entering a sell trade based on this signal and placing our stop loss above Kumo. Here are some more examples of this pattern forming, both upwards and downwards. An Ichimoku strategy that I personally use a lot and has a high win rate is when a prominent Kumo forms the right shoulder of a head and shoulders pattern. To gain a clearer understanding, let's look at the GBP/USD chart. Here, you can see that the currency pair has been in a strong uptrend for almost a year. This is further confirmed by the presence of a green Kumo. Every time a price pullback occurs, the cloud immediately comes into play, propelling the price higher again. However, after some time, a clear weakness in the uptrend becomes apparent. To better grasp this issue, we can also use the momentum indicator. As can be seen, this lack of strength is clearly evident on the momentum indicator as well. Therefore, we should be attentive to reversal structures in these critical areas. One of these patterns that can trigger a price reversal and change in trend is the head and shoulders pattern, which you might already be familiar with, as it is a widely known pattern in the market. It bears a striking resemblance to the QM pattern described in the first example of this video. In this case, we can observe that the price has formed the left shoulder and the head of the pattern. However, the right shoulder is still absent. Meanwhile, if we carefully examine the Kumo formation, we can see that a sharp pointed cloud is emerging, which can potentially serve as the right shoulder of the head and shoulders pattern. In this situation, a crucial aspect that requires careful consideration is the timing of entering a trade. This matter is largely subjective and depends directly on your trading personality. If you are a bold trader who enters a trade upon observing the first signs of reversal, you can consider selling when the Tenkan line crosses below the Kijun line. This premature entry, although it may put you ahead of other traders, is equally risky. As observed, the price, Tenkan, and Kijun lines are all still above the current green Kumo. Also, the future cloud has not turned red yet. Furthermore, Chikou span has not yet broken below price or Kumo. However, the encouraging point here is that the price will not encounter a strong Kumo in its path. It can potentially pass through the cloud with minimal hindrance. Moving on, it can be observed that the price has behaved according to our prediction and managed to surpass this thin Kumo with a relatively strong bearish candle. More cautious traders can enter the market by observing this red candle. However, it is still critical to note that the conditions for entering a trade are not completely ideal. This means there are still risks involved. Continuing on, it can be observed that all Ichimoku components have aligned in an ideal setup to support the continuation of the newly formed bearish trend. Therefore, more conservative traders can finally join the seller's camp with confidence at this level. As you can see, there isn't a universal holy grail in trading that works equally well for all traders. People can adjust their entry strategies based on their risk tolerance or aversion. The same applies to trade exit timing, which we will discuss further. Following that, the price initiated a strong downtrend. Therefore, we can determine our profit target levels based on past market behavior. Traders who were more risk-tolerant and entered short positions at higher levels can consider closing a portion of their trades at the first target level. However, given the strength of the established downtrend, the price may reach lower levels. Following the break of the first support zone, the price reached the second support area. Traders who join the market later may consider exiting a portion of their trades at this level. Prior to reaching this level, the price has encountered a large gap in its movement, which indicates a very strong momentum. Therefore, there is a possibility of reaching even lower levels driven by the high price momentum. In the following, it can be observed that the price faced significant difficulties surpassing this level. However, after a substantial pullback, it resumed its strong downtrend and even broke through the third support level with strength, completely retracing the one-year bullish trend that preceded it. I hope the strategies introduced in this video were helpful to you. As always, I recommend putting these techniques to the test and practicing them in your demo account before applying them in your real trades. Stay tuned.